Welcome back, everybody. In case you hadn't already heard, the bull market is apparently back.
Well, we got a couple of bullish calls out this morning. Both BMO Capital Markets and Deutsche Bank out with their new calls for the S&P 500 for 2024. They both see the S&P 500 reaching record highs of 5,100 by next year. And I want to start with what we heard from BMO Capital Markets. Brian Belsky there leading this call. And what stuck out to me, and you I think as well, is the call that he has for earnings growth next year.
Basically, I mean, this is a conversation that's been ongoing about, that quote unquote earnings recession being over, earnings we've seen the peak declines there and sort of rebounding, overall feeling better about the economy and the way companies have positioned themselves. And then that sort of leads us to the price target and sort of what Brian Belsky is overall saying here when he says normal for longer. So he's saying, we think we're in this stage now. We're normal for longer. Well, the second year of a bull market is about 11% in the S&P is the upside we'd see. That's what he's calling for. So he's sort of saying we're back to just buy the S&P 500 and things might be okay and you're going to go up 11%, which I thought was interesting.
So after a month where the S&P 500 went up almost 10%, we've basically gone from fourth quarter rally unlikely to new bull market is here. So how are we as retail investors supposed to process this? Oh, and if you're wondering, in my last video about Caterpillar, a couple people talked about their clothes in the comments, so I decided to wear my hoodie. And if you're wondering which one I had first, the stock or the hoodie, I had the hoodie first. Now, we've talked before about how back and forth the news can be, but I thought there was a really great interview on CNBC with Mark Avallone today, where, in my opinion, he addressed it all pretty well. So I want to play a few clips from that interview and talk through what he's saying specifically on the idea that the bull market is back.
Give us a sense. What's your take on BMO's take that we're on pace? We're seeing signals for another rally.
Well, there is a lot of good news and there's a lot of momentum. And there's been whispers of lower inflation, and that means the Fed can take its foot off the gas pedal and stop choking this economy. And all that is good. We're on board. We're investing. But I think if people just think it's a one-way market and happy days are here again uninterrupted, I think they should just be a bit cautious. We do want to see what quarterly earnings are going to look like. We want to see continued lower inflation print closer to the Fed's 2% target. There are some global factors that are still out there that are concerning. So yes, we're optimistic. We're in line with BMO's thinking, but we think that investors should still stay within their risk profile.
Now, if you watch this channel, you know that I tend to be pretty conservative in my approach to just about any piece of information. So I definitely agree with Mark's overall sentiment here, because he's basically saying that they are investing and they see good things out there, but that investors in general should stay within their risk profile and that it's not going to be a one-way market. So he's saying it's not going to be like 2021 where you could just buy pretty much anything and have it go up a lot. You still need to be selective and stay within your plan and your normal risk profile. And here he talks about why people should remain cautious in more detail.
Mark, walk me through this one. You say you want to see how earnings are going to turn out. We just are kind of wrapping up earnings season right now. We've had over 95% of companies reporting. I'm looking at the numbers right now. EPS 7% higher year over year. What else do you need to see from earnings?
That's a great question, but I want to keep in mind that the Fed rate hikes have a lag effect, and the lag effect by historical standards should be hitting us right around Q4 and early into Q1. So I think we're also looking at the recent wage gains that have happened in certain industries and healthcare, airlines, the autos. There have been specific industries that now are going to be dealing with higher wage costs. All industries are going to be dealing with the refinance of debt at these higher levels and the lag effects for consumers who have run out of some of that excess money. And we see it with the slight rise in delinquency, especially in subprime lending. So we think the lag effects may be a negative factor going forward, or at least something to keep an eye on.
And now we've talked about a couple of the same things recently on this channel. We talked about rising labor costs potentially impacting profits, as well as reduced consumer spending for companies like Texas Roadhouse. We talked about the potential risks of having to refinance at higher rates for companies with a lot of debt like Caterpillar. But as of now, none of those things have actually happened, and they're not showing up in the quarterly numbers for those companies yet. And to be honest, they may never actually happen. But part of the reason why I go through risks for every single stock analysis is because every single company and investment we make comes with risk. Choosing to invest is choosing to accept that risk, which is why it's critical that you understand what they are. So what I like about what Mark Avallone's saying in this interview is that it's not time to YOLO into meme stocks like 2021, and the stock market that we see going forward may be very different than newer investors have experienced from 2021 or even all the way from 2008. But he is still investing, he's just being more particular in what he invests in. And he finishes up the thought with this.
Look, I said earlier, I'm invested, we're on board. I just think that people are so excited to think that inflation has trickled down and the Fed is going to all of a sudden give this massive amount of liquidity and that it's game on again. I just don't see markets that way.
And I know this idea is one that people have floated around a little bit. The idea that the Fed is going to cut interest rates soon and it's going to send the market up again. And of course, we never know exactly what's going to happen, but if you just listen to how people are talking and what they're saying, I don't think a rate cut is likely. Because here's Jerome Powell back in September talking about expectations for a rate cut in 2024.
Yeah, so as we go into next year, that's the question we'll be asking is, taking into account lags and everything else we know about the economy and everything we know about monetary policy. The time will come at some point, and I'm not saying when, that it's appropriate to cut. Part of that may be that real rates are rising because inflation is coming down. Part of it just may be that it'll be all the factors that we see in the economy. And, that time will certainly come at some point. And what you see is us writing down, a year ahead estimates of what that might be. And, there's so much uncertainty around that. When in the moment, we'll do what we think makes sense. No one will look back at this and say, hey, we made a plan. It's not like that at all. These are estimates made a year in advance that are highly uncertain.
And then a few weeks ago, it was brought up again, and he was even more direct.
What then is the potential impact on the trajectory of rate cuts? Could we see those maybe pulled forward or have to see more than what the September SEP indicated?
So the fact is the committee is not thinking about rate cuts right now at all. We're not talking about rate cuts. We're still very focused on the first question, which is, have we achieved a stance of monetary policy that's sufficiently restrictive to bring inflation down to 2% over time, sustainably? That is the question we're focusing on. The next question, as you know, will be, for how long will we remain restrictive? Will policy remain restrictive? And what we said there is that we'll keep policy restrictive until we're confident that inflation is on a sustainable path down to 2%. That'll be the next question. But honestly, right now, we're really tightly focused on the first question. The question of rates cuts just doesn't come up because I think it's so important to get that first question, as close to right as you can.
Now, if you listen to that and you think a rate cut is definitely going to happen in 2024, I just don't know what to tell you, especially when the market in general is doing well and labor and spending reports have been either positive or not really as bad as people thought. And my point is, I'm not trying to convince you that everything's great out there, just that this overwhelming negativity hasn't been seen in the numbers yet. And the Fed's going to have to see those negative impacts in the numbers first, and then decide if the impact of those numbers is worse than the impact of higher than 2% inflation. And then, and only then, would they potentially consider a rate cut. But the challenge we face as retail investors, and we've talked about this a lot, is with all this information coming at us every day, how do we know which parts of it we should pay attention to and which parts we should just ignore? We started this video with BMO Capital Markets basically saying that the bull market is back and to expect a potential 11 to 12% return for the S&P 500 in 2024. Well, here was the same BMO Capital Markets Brian Belsky back on July 28th.
We've been saying now for several months that we have entered a renewed era of stock picking. And I don't think you want to be in these more passive type of index level ETFs, let's just say. I think you want to own stocks in here. And I think that portends to an overall trend, Melissa, I think many people are missing. If you go back and look at what the market's done in January and February, actually value was outperforming and small cap was outperforming. It was really the March kerfuffle with financials that kind of really kick-started this whole notion of what everybody likes to talk about as the Magnificent Seven. But what the thing that people are missing right now is that over the last 30 days, growth at a reasonable price has outperformed the S&P 500 by almost 300 basis points. But more importantly, and I think interestingly to us in our work, is that dividend growth as a strategy has massively outperformed the last 30 years, and no one is talking about that. I think what the issue is that we're starting to see a broadening out of the market, and you take a look at stock performance, earnings growth, valuation. The disparity within those three measurements is very wide. You want to buy companies that are earning money over the long term with proven track record in terms of not only their product or service that they're providing, but their company management as well.
So there's a lot there, but if we try to recap that clip and the more recent bullish news, he basically said in July that it's more about stock picking than index investing. Growth at a reasonable price is outperforming. Dividend growth is outperforming. Finding companies with earnings growth and good valuations is good. Market performance is broadening beyond the Magnificent Seven. And now, 4 months later, the same guy is saying the bull market is back and expect 11 to 12% returns just from the S&P 500 index. I mean, this is pretty confusing. And now look, a lot can change in 4 months. The markets can change in 4 months. The outlook for the country or the world economy can change in 4 months. The outlook and results of any one stock or company that we own can easily change in 4 months. But if your investing method and strategy is changing every 4 months, that's probably an issue. Because if you were an index investor in July and then you were a stock picker from July to November and now you're going to be an index investor again, I mean, that just makes no sense. We have to pick our investment strategy based on our own goals, experience, and interest. Chances are, if you're investing in indexes only, it's because you're totally fine getting a market return because you don't want to mess with it or don't think you'll be able to do a better job, or some combination of those things. You shouldn't worry about what people think the market will do. That's the whole point. Now, when it comes to picking stocks, it's a little trickier because when we hear new information, we wonder if it's an actual edge that we can use to get a good return. But anytime you hear someone talk about a stock without context, it's really not that valuable because the additional information you might need is what's their time horizon versus your time horizon. What's their investment strategy versus your investment strategy? What criteria are they looking for versus what criteria you look for? And when they say it's going to outperform, by how much? Or compared to what? Or on what timeline? But it just goes to show that understanding what we're looking for and why is infinitely more important than catching every tip or insight in the news. And I feel like you guys are going to stop watching my videos because I end up talking about the same stuff over and over. But honestly, defining your plan and expectations will always be one of the most critical steps you can do to be a successful investor. Otherwise, you'll panic that your stocks are going down in bear markets. And then you'll panic that your stocks aren't going up enough in bull markets, when all the while they may just be doing exactly what you expected and wanted them to do in the first place. So was the bull market actually back? I don't know. And the reality is that nobody really knows. But here's the trick. It doesn't matter. It doesn't change my process or what I look for in companies or even how I measure success on my plan. So for me, when I'm clear on what I'm trying to accomplish and I'm seeing consistent, meaningful progress towards my goal, then every market feels like a bull market. So what do you guys think? Is the bull market actually back or does it even matter? Let me know down in the comments below. Hope you guys have a great day out there. Financial independence is true freedom, so keep building and stacking wins, and I'll see you guys in the next one. Peace.